what I wanted to talk about today was the number one reason the stock market is going up that nobody's talking about. Hey, what's up, guys? Sorry we missed the last week or two of Wealth Talk. We're back now today. And what I wanted to talk about today was the number one reason the stock market is going up that nobody's talking about. So I was on Fox Business today talking with Charles Payne. A lot of people are really kind of scratching their heads where we're seeing a little bit of market volatility now. Absolutely. But at the end of the day, we've seen an extremely strong market. And if I thought back maybe a year and a half, 2 years ago, let's say pre-COVID, if the market was facing some of the challenges that we're facing today, we're hearing some more now in Los Angeles about ridiculously enough, a mask mandate coming back here. We're hearing things like, corporate earnings, maybe not quite as strong as some people may have thought. Most importantly, I think there's some pretty good conversations being had now about what do the valuations look like on a go-forward basis, meaning the price to earnings ratio, when we look at the S&P 500 right now, 22 times forward earnings. Traditionally, that's maybe 16, 17. That being said, when you look at how low interest rates are right now, meaning when you look at what the alternatives are for your money market accounts, bonds, and so forth, that's not really extremely expensive, but by no means is it cheap right now. What I would say to that, probably my biggest concern is in terms of valuations, 22 times forward earnings. Let's think about that. That's what analysts are predicting that the S&P 500 is going to do over the next year, not what they did in the rearview mirror. So as you would imagine, when you think about analysts' expectations, what are they thinking is going to happen? Well, they're thinking, as we've seen, that the economy is going to open back up. We've been talking about all this pent-up demand for consumers wanting to start traveling again, people going back out to restaurants. Let's remember, we're a consumer-driven economy, and when the consumer is locked in their house and they're not out there spending, that is not long-term sustainable for our economy. So when you think about analysts' expectations today, they are clearly expecting, when you look at the numbers, even at 22 times earnings, that things are going to open back up. So Charles on the show asked me last week, Rob, what is your biggest concern that you have right now in the stock market? And I said, it's this Delta variant of COVID. And I'm concerned that you're going to start to see cities, states starting to go back into lockdown mode. I said that last week. Just today, Los Angeles announced tomorrow that they're going to start putting that mask mandate back. And they said everything else is going to be data dependent in terms of further restrictions. Now, let's think about that. That does not give people a tremendous amount of confidence who may be planning a trip in 2 to 3 months, are planning different parties and things of that nature. If you're somebody who, number one, was on the border of doing that, psychologically, even though things haven't closed down yet, that's going to start impacting behavior. And that behavior is going to become contagious. And if you start to see people pulling back, not making those expenditures, not making those trips, not doing the things that analysts are expecting them to do, then what does that mean for that 22 times forward earnings? Exactly. It means that it's too high. It means that the earnings expectations, absent all of these different behaviors, absent the economy opening back up, are going to be too high. And 22 is not cheap. 32, 42 is definitely not sustainable. Therein lies the potential for the economy, therefore the market, to pull back from current levels. And so that was probably my biggest concern that I addressed last week. That's my biggest current concern that I'm addressing this week. If you look at things like inflation, the bond market has already dealt with that. So that's what the market's facing. That's why the markets on Friday saw a little bit of a challenge. But remember, this video is about the number one reason that the stock market is going up, not all the challenges that we're facing. But first, I wanted to make sure that I articulated there are some serious challenges in the market today. Does that mean we're going to crash? Absolutely not. But is this a sky is clear, go in full bore, all money into equities type of environment? Not traditionally based off of what you're looking at. So that got me to thinking is, With all of these headwinds that we're talking about, I've talked about a couple of them being valuations, being the challenge with COVID, earnings maybe not being as strong. We're very early on in earnings season as some people expected. Then why is it really that we're seeing people continue on every single pullback that we get? Why are people rallying? Why are people pushing this market up? And so what I really wanted to talk about today was the number one reason that I think that's happening that I don't really hear a lot of people on television. I don't really hear a lot of analysts talk about. And the number one reason is supply. We're dealing with a huge lack of supply, publicly traded companies, good ideas that people are able to invest in the market. Now, let's talk about that. In 1999, we had about 7,000 publicly traded stocks. There was 7,000 companies that you as an investor were able to put your money into. You would think fast forward, right, 21 plus years later, 22 years later, that there'd be at least, if I asked you, how many stocks are publicly traded now, you'd probably say maybe 72, 7,300. I think that would be a realistic assumption based off of the previous history prior to 99. But the reality is there's only about 4,000 publicly traded stocks now. So why is that? Well, I think it's a couple of key reasons. The number one reason I believe that that's happened, why there's so much less supply today, is that the private markets, and I've talked about this before on Wealth Talk, have gotten extremely large, which means traditionally companies raised money in the public markets. They stayed private, they came public to raise money, to get capital from shareholders to invest, hire more people, invest in better technology. Just when you saw what you saw in 1998 that Amazon did, right? They just had a few hundred employees back then, a very small company when they went public. They took public capital to grow that company to over $1 trillion to the behemoth that it is today. So that was the traditional route for companies going IPO, initial public offering, listing their stock on the NASDAQ, listing their stock on the New York Stock Exchange to get investor shareholder capital to bring that in and grow the company. And that's what they did traditionally. Therefore, also as an investor, like if you invested in Amazon, $10,000 back in 1998 in that IPO, when it came public in the public markets, you made millions of dollars because a lot of that growth was ahead of the company. A lot of that growth was going to be created from that capital that it received from going public. But today, private markets are so liquid. A lot of high net worth people are buying these companies. We saw Coinbase go public just a little while ago. A lot of these companies are being bought in the private market, being via private equity. Those markets have gotten so big that when companies come public now, they're not billion-dollar companies or $800 million companies. They're $100 billion companies, $50 billion companies, sometimes $150, $200 billion companies. These are huge companies, which means when they do that, come to public markets later, that a lot of the extreme, hyper fast growth is actually behind it. Not that they still can't grow 20, 30%. We see that. Not that some of them can't grow 100% year over year, but in large, the companies that are coming public today are not growing as fast. They're not as small because those public and private markets are getting them where they need to be. So companies come public much, much, much later. So you're not seeing as many companies go public. There's another thing, number two reason to where I do not think there's nearly as many companies that are public today was something called Sarbanes-Oxley. This was a law that was pretty much enacted in order to, really dial in financials of publicly traded companies, make sure essentially that another Enron was not going to happen again to people, to where you had CFOs and people that are involved with the financials of publicly traded companies being held responsible for any miscalculations or really any fraud that's going on with those. And so what has to happen is they have to now sign off on those financials and therefore leave themselves personally liable for any misdoings that are going on at the company. And so when that happened, I think a lot of people did not want to be public. They did not want to play that game. And so Since 1999, the float, and the float is a word you should understand, that's how many shares are out there trading of a company. The float is also just how many public companies are out there. It's almost been cut in half. And so that means investors that are going to buy stocks, instead of 7,000, that same amount of money has to go to 4,000. And so what does that mean? That's just a supply demand issue. You have the same amount of capital or greater capital that we're seeing now because there's a tremendous amount of liquidity in the market. There's so much money in the marketplace today because of stimulus and all these things that we know that are going on. There's no really big competitor right now because, as we talked about, interest rates are so low. There's a tremendous amount of money, but instead of chasing 7,000 stocks, they're only chasing 4,000 stocks. To add to this number one concern why stocks are going up, there's also, I believe, greater shareholder interest now. Look at just Robinhood and things like these brokerage accounts that weren't around 3 years ago. I think the innovation of some of these democratized platforms to get more shareholder interest, which I think is an amazing thing, getting more participation into the market, more activity and action into the market, more educated investors, like with my own Wealth Academy. We're working with millennial investors to speed up the learning curve. Like our millennial investors are going to be smarter than the average investor, smarter than the average financial advisor, quite honestly, in the next couple of years, because we are teaching them how to analyze stocks, how to trade, how to look at technical analysis, how to build long-term investment plans for themselves so they're making long-term strategic decisions. So the average investor, which people used to call the dumb money, I believe is becoming the smart money. And you're seeing the way that markets move today is significantly different than they moved in the past. The way that the analysis that I'm doing today to construct portfolios, to choose individual stocks, to analyze companies, management teams is significantly different than I did a decade ago. Yet the big brokerage firms on Wall Street are still business as usual. And because they're so tied into cost structure, they're so tied into this hierarchy that they've developed, they are too big to be able to pivot. So they will continue to go that direction and talk down the market. So these are the people that thought a year ago you should have been out of the market, yet the market continues to rally. So as we get newer retail investors, which are becoming a much more important and sophisticated part of the market, again, with COVID happening last year, we brought a tremendous amount of new investors into the marketplace. So let's think about that. We've got now a stock market, when you look at the whole market, that's almost been cut in half as the number of companies that you can invest in. We've got a situation now where there's not a lot of alternatives. And importantly, we've got a lot of new, more sophisticated, longer term thinking investors that when they look at, hey, the stock market actually can create wealth. And it's not as intimidating as I thought it was to invest in good, high quality stocks. And if I invest in them in an educated process with a methodology of how do I buy, how do I sell, how do I construct a long-term investment portfolio? And that's different from just buying a bunch of random stuff. A portfolio that's constructed to generate wealth, that's constructed to generate income for me. They're starting to think that way. And I can tell you, I work with these guys. They're very, very smart. So now you have all these new investors just over the last few years coming into the market, having access. Let's remember, commissions are zero now at most major brokerage firms. So they can get in, buy for nothing. They understand the value of owning equities over the long run. They also see the dollar, not that stable. So they want to own something that no matter what currency they operate in. So if you own Amazon or Microsoft, they operate on a global scale. So they're operating in China and Europe and the US. They're not tied to just the US dollar. And hey, they're positioned to where, hey, if some of these countries, or if crypto became the asset of choice, these are companies that are offering assets of value that no matter what the currency is, are going to be able to appreciate. So equities right now are being recognized as a really good place to go by a lot of new investors at a time where the supply has been cut in half. And you're not hearing about that. You're not hearing about that at all because that is not a narrative that Wall Street wants you to hear. The narrative that Wall Street wants you to hear is sell your stocks to me because our old methodology has not caught up yet. And the only way that we're going to be able to get positioned the way we need to is for you to sell your stocks to us. So the education process for today is to realize that the amount of stocks that were available in 1999 have almost been cut in half over the last 22 years, right? The thing to realize today is that the average individual investor, you, who they want to call the dumb money, is educating themselves to become the new smart money. Access to a limited number of stocks is now being chased after by a much larger scale of investors that are going after them. People are starting to now recognize and appreciate the value of owning companies that are able to pass on inflation, pass on currency differentiations to their consumer because they're creating products that are demanded that people want, right? And also the thing to realize is that if you continue to listen to the traditional Wall Street approach, old school way of building portfolios, old school way of analyzing stocks, those people have been wrong now for 5-6 years. They're going to continue to be wrong. You have to start thinking differently about the stocks that you own. And so today, that was kind of the lesson of when you're scratching your head of, there's some news out there that might not necessarily be the best for stocks. But when you think about everything, what dictates price? It's supply and demand. And right now, I think we're at an all-time high in terms of demand on stocks. I think that's going to continue over the next 1, 2, or 3 years. And unless something happens to supply where we start to get more publicly traded companies coming to market, you're going to continue to see a lot of assets chase these companies higher. So that's Wealth Talk today. Have a great weekend. We'll definitely be back next week. If you haven't subscribed to my channel yet, please subscribe to this. Share it with a friend. I appreciate you. Good health and good wealth.